A signal that's only appeared 3 times in the last 50 years just flashed red on the housing market. And every single time it happened before, what came next changed everything. Look, I know what you're thinking. Another housing market crash video? But hear me out for a second. This isn't about some guru's prediction or a desperate clickbait headline. This is about cold, hard data. Data that even the biggest skeptics are having trouble ignoring. So buckle up, because what I'm about to show you is genuinely wild. All right, let's start with this. Imagine the housing market is like your friend Dave. You know Dave. Usually pretty predictable, right? Shows up to parties on time, orders the same burger every Friday night. But then one day, Dave shows up to a casual barbecue wearing a full tuxedo, speaking fluent Mandarin, and riding a unicycle. You'd immediately think, okay, something is seriously, fundamentally wrong with Dave. You'd be looking for the hidden cameras. That's essentially what just happened in the housing market. The signal I'm talking about is called the mortgage rate inversion spike. And before you click away thinking this is getting too technical, stay with me, because this is actually insane. Here's how it works, and it's simple. Normally, when mortgage rates go up, home prices have to cool down. It's basic economics. Higher rates mean fewer people can afford homes, so sellers are forced to lower their prices to attract the buyers that are left.
It's like when concert tickets are way too expensive, and then suddenly, Ticketmaster starts mysteriously offering last-minute discounts. But right now, what we're seeing is completely backward. Mortgage rates have jumped nearly 3% in just 18 months. That is the fastest, sharpest increase since 1981, and yet home prices in major markets are still hovering near record highs. To put this in perspective for you, the average monthly mortgage payment has shot up by over $1,000 for the exact same house, yet people are still paying top dollar. We're literally watching people pay more for the privilege of affording less. It's like, Dave, the housing market is defying gravity, or economics, or both. Now, this exact bizarre pattern has only happened 3 times since 1970. 3. First in 1979, then in 1989, and again in 2006. And if you know your history, you know what came next. After 1979, home prices dropped 7% in 1980. After 1989, they fell 14% by 1990. And after 2006, they crashed a staggering 27% between 2007 and 2009. The average drop? A 16% decline, all within 18 months of this exact signal flashing red. Spoiler alert, it wasn't pretty for anyone caught on the wrong side of it. Now, I hear it already.
Every economist and their mother is shouting from the rooftops, but this time is different. And look, to be fair, they might have a point. Let me play devil's advocate for a second. The argument goes like this. We have a massive, undeniable housing shortage. Millennials and Gen Z are finally in a position to buy homes. Boomers are aging in place and not selling. It's like a game of musical chairs, but there are 100 people fighting over only 60 chairs. In that scenario, the price of a chair is going to get pretty crazy. Right now, the U.S. is short approximately 4 million homes, the worst shortage we've seen since World War II. That's not just a small gap, it's a generational crisis that in theory should prop up prices no matter what. Plus, unlike 2008, we don't have that subprime mortgage time bomb waiting to explode. Banks aren't just handing out loans to anyone with a pulse anymore. Credit standards are actually pretty tight. So maybe, just maybe, the housing market can stay irrational longer than we expect. Maybe this is the new normal. But here's the thing, and this is where it gets spicy. Every single time in history that people have confidently said this time is different, they were eventually and often painfully proven wrong. Sir John Templeton, one of the greatest investors who ever lived, famously called those 4 words the most expensive words in investing. And he was right, every single time. It's the economic version of hearing someone say, famous last words.
Let's continue with the domino effect nobody's talking about. Let me paint you a picture of what's brewing right beneath the surface of the housing market. Right now, millions of homeowners are sitting pretty on mortgages with rates between 2.5 and 4%. These people are, for all intents and purposes, locked in their homes, because moving would mean trading that sweet 3% mortgage for a brutal 7% one. It's exactly like having a rent-controlled apartment in Manhattan. You are never, ever leaving. This is what economists call the golden handcuffs effect, and it's choking the supply of available homes to a trickle. But here's the first domino. What happens when the economy softens, when layoffs start to climb? What happens when people have to sell because of divorce, a job loss, a mandatory relocation? Here's the scary part. Over 60% of homeowners say they would never sell at the current rates. But life doesn't really care about your mortgage rate. And statistically, 10 to 15% of homeowners will be forced to move within the next 2 years, regardless of rates. Suddenly, all those locked-in homeowners become forced sellers. And when a flood of forced sellers meets a market of buyers who can barely afford the current prices, you get what's called a liquidity crisis. Prices don't just drop, they crater. And unlike 2008, where the crash was spread out over 2 long years, this could happen much, much faster. The market is so illiquid right now, we're talking months, not years. It's like a dam holding back a massive amount of water. Everything seems perfectly fine until one tiny crack appears, and then, whoosh, the whole thing goes. So what are the people who actually know what they're doing up to? What's the smart money doing? Well, institutional investors, the Blackstones and BlackRocks of the world, have quietly started pulling back from buying residential real estate. In the third quarter of last year, institutional buying dropped 23% compared to the year before. That is not a coincidence. What's even more telling? They're not just buying less.
They're actively selling properties in secondary markets and hoarding cash. When the biggest players in the game move to the sidelines, they're not just taking a coffee break. They're expecting a fire sale. Meanwhile, billionaire investors like Jeff Green, who made an absolute fortune betting against housing back in 2008, are starting to make noise again. He recently said, and I quote, "The housing market is more overvalued now than it was in 2006. And he's not alone. Hedge fund manager John Paulson, who personally made $4 billion shorting housing in '08, recently said he's watching the housing market very carefully and sees troubling parallels. When the guys who got rich from the last crash start circling, you pay attention. Now, I'm not saying you should panic and sell your house and go live in a van, but when the smart money starts backing away from the buffet, maybe it's worth asking if the shrimp salad is still fresh. So let me give you 3 possible outcomes, ranked from mild inconvenience to oh no. Scenario 1, the soft landing. The Fed somehow brings down inflation without crashing the economy. Mortgage rates gradually slide down to around 5%, and home prices either stabilize or dip slightly, maybe 5–10%. This is the perfect Goldilocks scenario. Is it possible? Sure. Is it likely? Scenario 2, the slow burn. Rates stay high for longer than anyone expects. Home prices just stagnate for years while inflation silently eats away at their real value. You don't see any dramatic crashes, but homeowners feel poor and the market stays completely frozen. It's like economic purgatory. And then, scenario 3, the correction. A recession hits, unemployment rises, that wave of forced selling begins, and prices drop 20 to 30%, especially in those overheated markets. It's not 2008 level chaos, but it's painful. And this is what the historical pattern suggests. Look, I'm not here to fearmonger or tell you to sell everything and buy gold bars, but I am here to tell you that ignoring rare historical signals is exactly how people get caught completely off guard. Whether you're a homeowner, a renter waiting to buy, or an investor, the absolute key is to stay informed and stay flexible. Don't overextend yourself. Keep your cash reserves healthy. And maybe, just maybe, don't assume that home prices only go up. Because if history has taught us anything, it's that Dave eventually takes off the tuxedo, crashes the unicycle, and admits he has no idea how to speak Mandarin. Stay smart out there.